If you've ever wanted to build your own share portfolio but just didn't know where to start, this is the segment that you want to watch and pay very close attention to. Joining us now from Cape Town to share 3 easy steps for you on how to build a portfolio like a pro, a Skalk Low portfolio manager at PSG Wealth, and of course a regular Finweek contributor. Skalk, thanks for your time. So I've never put a portfolio together. I'm watching this show. Where do I start?
Hi, Tumi, and thanks for having me. No, I think when I originally wrote this article, and I think I've wrote this report a few times already over the last 5 to 6 years, I think I'm now at the point where I might have to change the heading from building your portfolio like a pro to borrowing your portfolio from the pros. And I think that in general is what I'm trying to do, and just to move one step back, this is not my portfolio or PSG's portfolio. This is a portfolio that I'd like to find a way of making portfolio management or managing your own portfolio simple, easy. And what I've done is I've worked on 3 very easy steps, where I start by looking at the equity funds, and more specifically the general equity funds, who's got a mandate of tracking and benchmarking the FTSE All Share. And again, don't only look at your 1-year track records, because I mean you tend to get that 0 to 0 effect. The guys that didn't have resources or had many industrials in a resource slump. I like to look a little bit longer, your 3 to 5 years, and not only your performances, looking at things like, for instance, your risk-adjusted returns. I narrowed that down to about 10 unit trust. And what was interesting over the last, let's call it 18 months, that unit trust tend to stay the same. I mean, out of the 10 equity unit trusts that I used 18 months ago, for instance, 6 of them are still, the top 10 currently. So they don't really, I mean, it weren't a flash in the pan scenario. And what I do after that is I drill through, and this is very, very easy to use. I mean, you can find this on the web, you can find it on financial websites. Go and look for the fact sheets, or how they call it these days, the minimum disclosure documents. And I look at the top 10 shares that these funds are holding. And you very quickly see, out of this 10 shares or 10 unit trust, a golden thread, the Naspers that they hold, the Old Mutuals, the Aspens, those type of shares. And then finally, I look at the weightings they allocated to these 10 shares, and I build let's call it, I take it to 100%, where I use the average 10 most popular shares within the top 10 funds.
Skalk, so what was in that portfolio 18 months ago? What shares did you choose, and how did they do? How are they currently doing?
Well, it's been phenomenal. I mean, like I said, I've been running this for 5 years. And again, I just want to move back one step. I mean, remember, this is hindsight. I mean, and many people have told me, remember, I mean, this is sort of the herd effect. This is sort of looking hindsight, looking backwards. And yes, it's true. But still, I mean, it sort of safeguards the clients or the investors that don't have privilege to a big research team or analyst. 18 months ago, those 10 shares were you were looking at the Anglos, Bulletin, Bidvest, First Rand, Mr. Price, MTN, Naspers, Reinet, and Sasol and Steinhoff. And they've done very well. I mean, if you look at over the last 18 months, the stock market has produced a total return of 11%. Your general equity unit trust managers manage an average of only 6% versus the 11%. And this portfolio has done fairly well. I mean, looking at only a 10-share portfolio, it's produced a 16% return compared to the other. I just want to make it pertinent. I mean, you don't have to use only 10 shares. I mean, for people that's more risk averse, can extend that to 15, 18, or maybe 20 shares. I've used 10 shares to make it simple and keep the article short.
So Skalk, how often should I be reviewing my portfolio? You did this, you looked at these 10 shares 18 months ago. The economy is different, markets are different. How often should I be reviewing and putting things in, taking things out?
To me, I think you've just said it. I mean, the economy and the investment environment is changing so often. So it's difficult to explain to an investor or reader out there to don't worry. Switch off your portfolio of your computer. Don't monitor it. Warren Buffett has had the very, very nice answer when they asked him, what is his favorite time to sell a share, and his answer was never. So I think when you've got that answer that you don't want to never sell a share and you want to do your homework right the first time, you should be able to only monitor your portfolio every 6 to 12 months. And in principle, it doesn't work that way anymore. Unfortunately, we're in a very, very volatile investment period.
What is the best set of advice that you can give to an investor at the moment? I mean, you said maybe think long term, so don't be checking your portfolio every hour to see how it's going. But what else do you think are some of the common mistakes that you would like to alert investors to?
To me, I think that the biggest advice I can give everyone is take the emotions out of your investment portfolio, especially your equity portfolio. I want to make it very, very pertinent that we're currently sitting in a very volatile period, and I still feel that the current levels the market is high. We're in for a bumpy ride over the next 12 to 18 months. So I would say keep the emotions out of your portfolio and maybe turn towards a more cautious defensive stance, looking 12 to 18 months forward.
Skalk, so hold on to your seats. It's going to be a bumpy ride, and also hold on to those stocks. Take your emotions out of it. Skalk, thanks so much for joining us. Skalk Low, Portfolio Manager at PSG Wealth, of course, taking us through how you can build your own portfolio.